Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy, live streaming here in TikToker. Let's move right into the live trading room here and take a look at the price of gold trading last at 1842.43 in a fast market, up 780. We've been pretty much all over the place this morning with a low of 1817. The silver market is 25.08, up 44 cents, up about $1, up about 1.70%. The E-mini is down about 30 points, 37.8775, and we seem to have entered into an area of support on the mini into the buy one level. Needless to say, from a fundamental point of view, the pretty much actions that we've seen in Washington the last week or so have been unprecedented. And it certainly has created a certain amount of nervousness in the market that is creating volatility. And yet the stock market continues to move up on the face of all this uncertainty that we have politically. This has overtaken the pandemic issue that we need to address. We are at peak numbers in terms of infections. We're beginning to see the effect of the holiday season upon us. And I wonder, with what happened here recently in Washington, there's going to be another wave of infections that are going to be developed. The numbers continue to increase. They're not changing. And so I think that regardless, I think one has to take this seriously, and we got to take it upon ourselves to make the right decisions for ourselves, for our families. How this whole situation is affecting into the gold market is actually, one of the reasons why I'm focusing on the metals, because I think that what we're looking at is the market discounting some of this early buying that came in, and the market here, in the gold market in particular, doesn't like company, and so it will suck you in, so to speak, at the extreme above the mean, and then the market will revert, which it did from 1962. We've come down to 1817, and I think it's a question of whether the 1817 is going to be the floor for the next rally. One of the comments that I want to make here is that, first of all, I appreciate all of the positive comments that people are making here with the work that I'm doing, with the reports that I'm publishing, and I really make an effort to be completely transparent. But if anybody out there is under the perception that this is a guaranteed program, I think you better go somewhere else. There's no guarantees, and it doesn't mean that because I produce a signal here given by the VCPMI that it's a guarantee that you're going to make money. So when you are, if you are following me, please take into consideration your profile. Please take into consideration risk and money management. If you have any questions at all in terms of how to apply this algorithm with regards to any specific question, please reach out to us. I use a simulated platform because if you're a self-directed individual, this is a good chance for you to simulate what I do to see how accurate the algorithm is, and at some point decide, after a number of consistent trades that you feel comfortable with, or at least you learn how to apply it, then you can begin to trade in real time. What I'm finding is that some people think that because the signal is produced, it's a guaranteed. When I talk about a probability factor, let me clarify the core and the basis of the algorithm. In essence, it is the core of the supply and demand that we're going to see in this case for the trading session. And so we use pivot points to identify the levels of support resistance, but the artificial intelligence of the algorithm goes deeper into transforming this pivot points into a more active indicator with multi dimensions in terms of the probabilities above or below the mean. The VCPMI is the average price that we have identified for the day to be at 1917. I want to double check my numbers here for a minute, if you bear with me here. The daily average coming into today is 1865. And it seems to be matching the monthly average at about 1864, 65. So this is a perfect classic example of what I mean by the artificial intelligence identifying a harmonic alignment. A harmonic alignment is basically when the price, whether it's daily, weekly, or monthly, is aligned almost at par. And here you can see the monthly is 1865, the daily is 1864, 65. So this represents a very important pivotal point that indicates if we are able to close above 1865, it's going to be extremely bullish for the market. So I can identify here my pivotal points. We've made a low here almost into the buy one level daily of 1812, not quite coming down, which means that we identify buyers sooner than the expected price, because the market is the only one that will know where it wants to go. And no matter what you and I try to do and figure it out, the market will do what it's going to do, no matter what. And so the algorithm basically allows for the market to resolve that momentum or volatility. And then when it reaches this pivot points, it activates a trend alert. It activates a signal. When the signal is activated, it gives you your target and your protective level. Let me discuss the protection for those that need to understand that we don't use straight stops. The majority of the times, straight stops get stopped out of the market. So The only time that we recommend for you to use a straight stop is by basically trailing the stop as the position begins to work in your favor. If you bought it, let's say theoretically at 1817, then if you want to hold on to it till the extreme target above, then you hold on to by trailing a stop. And if it comes down below your stop, you get stopped out, but at least you can lock in either break even initially or a small profit. When the signal is entered, depending upon how conservative or aggressive you are, you can use the close of the 15-minute bar. If it closes below, at the close of the 15-minute bar, upon you entering your trade, if you're conservative, you can stop that at that point. I pretty much measure the risk according to the volatility of the market, and regardless of any program or signal or recommendation made, I recommend that you carry a dollar stop, a maximum catastrophe dollar stop, which is what I call, underneath the trade. In cases like last Friday, last week, when you get those washouts, which sometimes can take quite a bit of an equity of the equity you build, that can help. That can help tremendously. So based upon your profile, have a maximum dollar stop underneath the signal. And that way you know that regardless of what happens, that you have a protective level below, and then you can allow the market to move the direction that it wants to move. One of the main factors that we saw the precious metals markets last week experience a setback or a correction was because the 10-year yield, the 10-year note yield, went up about 1%, and that is interest rates, going up, which is contrary to the fundamental picture that demands that the Feds continue to keep interest rates at bay or interest rates low or at 0% as long as they can, because the danger is if interest rates begin to increase on the face of this tremendous bubble of debt that we have, it is going to put more additional pressure to the system, to the Feds, and it's definitely reflecting in the weakness of the dollar, you might say, as a consequence of all of the stimulus that's coming into the market or maybe required, is going to jeopardize the purchasing power and the intrinsic value of the U.S. dollar as the world's reserve currency. And so interest rates right now are important, but I believe that the Feds, they really have no choice except to keep interest rates low in order to continue to fuel and finance this crisis. The worst thing that can happen is that we get interest rates above, let's say, 1.5% on the 10 yield, and then at that point, I think the economy is going to begin to feel the pressure or the heat on interest rates, and it doesn't bode well, obviously, for this tremendous real estate bull market, supposedly that we have this bubble that I think at some point is subject to a major collapse, really, as opposed to holding any kind of fundamental support economically, or at least from the interest rate related issues as far as the cost of money is concerned. If the cost of money begins to increase, obviously it's going to put a tremendous pressure on this bubble of debt that we have, not only here in the United States, but on a global basis. So I think this correction that we saw in the gold market last week was a technical washout correction that the big players, so to speak, in the market will use against the sentiment. And, the market is completing technical indicators. The 1962 was a monthly target. When we came in, we've been working with that level since the beginning of the month. And the only thing the market did was basically reach that level and allow for the supply and demand to resolve itself up there. And obviously what we saw was this reversion to sell-off that always on the short side of the market is accompanied by a huge amount of short sellers that are essentially paper supply that comes into the market. And when you take a look at the Commitment of Traders report every week, what you see there is the central bankers have the largest short position. They have added like 13,000 contracts on the short side of the market, which is completely paper supply. And as they obviously take advantage of the sentiment of the market, which was extremely bullish as we came in, this week, we see this reversion occur. We see these reversions occur in the market. And what will usually happen is the markets will come down to the extreme below that mean. And so here what you see is the market on the monthly coming down from the extreme above the mean with a sell one level of 1950 to the extreme almost below the mean of 1816. 1817 is the low. We had a monthly number of 1816, and right below it we had the annual number of the 360-day cycle at 1810. So I think this certainly are levels that indicate the possibility that we might have seen the lows at 1817. And if we get back above 1864, that's going to be the confirmation. $1865 will bring in the daily, the monthly, and above 1880, it will bring in the weekly as well. So we are getting you can see a turnaround, what looks to be almost, some kind of a head and shoulder bottom formation. So there are no trades basically for day traders today, as the market hasn't activated a day trade, but it is neutral to bullish based on the average price. And what we want to see is, again, the market trade about the average price of 1865 or ideally 1880, and see what it does when it gets up there. And then we can make some calculations and recalibrate basically our position. But in the meantime, we want to be long the market. We want to be prepared to add to positions here as the VCPMI is looking for the completion of this correction, short-term, intermediate, and long-term. We're beginning to see again what appears to be inflationary pressure coming in from the grain markets. I've been talking about this for those traders that are interested in trading in the grain. We reached a high in soybeans of 1388, and the grains, have gone up from about $8 a bushel back in March to about $14 a bushel. So that's a huge increase in the wholesale aspect of soybeans, which is a leading indicator for the economy. It's a leading indicator for food prices, as it is used for human consumption, for animal consumption, and for industry as well. So we're tracking, soybeans. We've been tracking soybeans since March, and it is confirming and validating we're moving into an inflationary period. And the prices of grains, the increase will be reflected here retail as we move into the summertime. The problem is that with these lockdowns, we're cutting supply. We're breaking the supply chain. Once again, it hasn't replenished, you might say, the previous disruption that we had, and now obviously we continue to see the pressure coming in from this current lockdowns that we have, as far as the ability to have ample supply come into the market. So I think, again, what I'm looking at and why I'm positioning myself here in precious metals is because the situation really hasn't resolved itself, and it's going to lead to a lot of anomalies as we come into some kind of normality once again, economically. People have been locked under lockdown now way too long, and people can't wait for this vaccine to begin to work so that we can get back to some kind of normality in our lives, in our businesses, if we have any left, after this mess. There's going to be a demand, a huge demand for goods and services. And what I'm looking at is the possibility, and I want to see how fast this, or how the velocity of money comes back into the system. And that's the indicator, I believe, that even the Feds are watching here with regards to any policies as far as managing the yield curve. But if we, I believe if we get the pressure on interest rates long term, I think we're going to see the Feds control the yield curve without a doubt. They just cannot afford to have an implosion in the system based on an increase in interest rates. And my opinion is that the last resort, I think that the Feds will have will be to cap the interest rates on the 30-year bond, particularly if we get the inflation about 2%, which, according to some of the indicators that we use, and according to the stats of shadowstats.com, which track the real economy, are indicating that we are already dealing with the high levels of inflation. And certainly, I don't know about you, but I can feel it where I live. It certainly is an issue that we want to watch. There are a number of issues that are so to speak unresolved as we get through this pandemic and come out on the other side. We're going to see pretty much the damage that has been done, and I don't know if we can at this point, since we seem to be in the eye of the hurricane at this point. Let's continue to just watch the market here and let's see where it wants to go here throughout the day. But we're looking for the market to be continuing the uptrend and ideally to move above 1865. Getting kind of quiet. 1848 trading. $48.20, which seemed to be holding this 1848 level, which was the previous average price of last week here. $47, 40. You know, we have a lot of trading going on at these levels here. Let's take a look at the daily chart here. What you see here on this chart is a combination of different indicators that I use that overlap the VCPMI for confirmation. And what we see here is that the low today came right into this vortex, so to speak, that combines this trend line, this long-term trend line, Fibonacci trend line support. And right underneath it was the buy one level of the daily, about 1812. So this action in the market coming down to this level and reverting from here seems to be putting in an extremely bullish reversal, potentially a key reversal day as we continue to unfold throughout the day. And if we get a close above 1865, that would be considered a major key reversal day to the upside, and it will validate and confirm that this low that we saw today here, that in fact coincides with the Bollinger Band, the lower level of the Bollinger Band came in as a major level of support. A little sell-off here, a little profit taken coming in here, 46.30 last. $46.10. I think the fact that the market came down to this low level of 1817 is a really great confirmation upon the reversal here that this is where the buy-in occurred, or the buyers were identified. And that's what we want to do. And these numbers, that we use basically are used to identify where those buyers are or where those sellers are. The algorithm tells us this is the probability area where if the market comes down to these levels and activates a reversion, this is where potentially the buyers are going to come in. And so that's what we see in here. We're seeing some reluctant buying, obviously, slowly coming in here, but the market is inching its way up here after the major sell-off that we saw on Friday. This correction, you will look back a few months later, will turn that to be a major level and a major buying opportunity. That seems to be the case with the gold market, that whenever we see major sell-offs in the market, that usually is the time for you to accumulate long term. That usually is the time for you to get in and average your price, because the price of gold is going much higher. There is no doubt, with all of this nonsense that's going on economically, politically, the system is completely out of whack. The system is broken. The old system as we knew it is broken. And a lot of the money initially, the panic and the fear went into, Bitcoin. As we take a look at the Bitcoin GBTC investment trust that we trade, the market has reacted in after making a high of 48.65 last week. We're trading, and it looks like a huge major top has come into the Bitcoin market, or the virtual currency market. And so, yeah, we want to trade that, but we don't want to chase the blow-off stage. That seems to be the case. And we want to see the market now relieve itself and come down, so to speak, into real levels of support, and then see how it reacts to there. But the panic, you might say, of what happened here, the money, the fear went into this asset that I think was a big mistake. For those that think that Bitcoin is going to replace the gold market, are going to find themselves in a bit of a mess, as what the Bitcoin is it's a virtual asset with tremendous volatility that you want to be traded. You want to trade Bitcoin and buy gold long term. That's the trade, basically. All the money you make in Bitcoin, take it and put it into gold. Buy gold physical, buy gold assets, increase your exposure to the gold market. In my opinion, by at least 1/3 of your net worth. I think you'll find that equation, that level, is going to protect you in more ways than you imagine in the big picture, as we unfold into this decline of the US dollar, which inevitably is at hand as we continue to supply quantitative easing, money created out of thin air. can only result in an implosion in the intrinsic value of its currency. And remember, we're talking about the US dollar as the world's reserve currency. So the money now is coming back into gold. If you're smart, you sold your Bitcoin. Now you take those profits and you buy gold. You accumulate gold. Because gold could go to 30,000 as Bitcoin did. If Bitcoin was able to go to 30,000 in an uncontrolled environment, I think the gold market certainly can move half of that, at least, if we get the amount of buying interest to override, so to speak, all of this tremendous selling pressure, this paper selling pressure that comes into the market every time we make new highs here and clobber, so to speak, the values and the price down to the extremes below the mean. But understanding the function of that manipulation and taking a look at the market from a technical point of view, anytime that you see a major sell-off in the market moving forward, you want to accumulate gold. You want to accumulate precious metals. $18.49 traded, $18.49. We are finding buyers here on any dips, it seems. $25.78 is the target for the silver. It's up about 62 cents. There are a lot of sore traders out there from last week. A lot of the longs in the metal got clobbered. A lot of nervous Nellies got stopped out of the market. A lot of traders pretty much liquidated their long positions, and it is just what the market needs because obviously you see the market now substantially higher in silver, gold, after the sell-off here. So that's what I mean by using, if you want to position long-term, use these corrections in the precious metals to add to your long-term positions. As the market needs to price in a great deal of risk economically and a great deal of risk politically. And I'm truly surprised, to be honest with you, that the metals are still down here. $47.5 trade. It's a very quiet day here. There's no trades for day trading here. So I'm just watching the market here patiently, letting it resolve this supply and demand here down here. In the silver market as well, you see we came down into this level of support using the Fibonacci trend lines, reverting right from the sell at one level weekly, and found buyers here at the low of today, which was 24.36. We're trading last 25.18. That's a pretty good indication that there were buyers that showed up here. Buyers that were willing to take the supply into strong hands. And that seems to be the case every time you see the market, come down even into this low here, 1867, was the market exchange hands from weak hands to strong hands. This correction here coincides with a normal correction testing this previous levels of support. And again, if we get this market to move up about 1865, that's pretty much going to confirm that this low here is the secondary low that validates the confirmation that the 1767 is going to be the low of this move, and that essentially was the low for 2020. This is a counter trend swing correction to test this level of support, and what I'm expecting is that we're going to see the price close above 1865 and validate this, or come down and test that 1812. But right below that 1812 daily, you're looking at the weekly 1798, then the daily 1775. So this whole area below 1812 is a highly regarded area of accumulation of supply, because the probabilities we're looking not only daily but weekly are indicating an area of major support. And this is how I identify pretty much where my buying level is at its highest probability, you might say, below the mean, where I can begin to manage my positions intelligently or manage my inventory intelligently. If there are no day trades, obviously we came in long here. We covered our shorts last week. We recommended in our trading room, in our private trading room, to cover our shorts. And even though the gold market is up here a little bit, we seem to be lagging a little bit behind on some of the derivatives that I think as we move in throughout the day, we're going to begin to see an adjustment in the derivatives markets as well, so that this move will be supported by the equity, by the share side as well. So I'm feeling pretty comfortable in telling you that you want to hold your net long positions. I'm holding now my net long positions. I'm looking for a rally, possibly to about 1880. So I want to build some equity on open positions, and I recommend that you continue to do the same. If you missed buy-in before, again, this correction provides a great opportunity to do so. $18.50 traded. We seem to be holding around a 38.2% Fibonacci retracement of 1847 as a level of support. Not much volume, not much volatility here today, and so it's a good day to catch up, so to speak, with anything else you got to do administrative wise, or sometimes it's a relief not to have to trade and yet manage your inventory so that you can continue to be involved with the market, one way or another. We got a long way to go here in terms of the gold market to the upside. And I think that February, sometime in February, maybe the middle of February, could be an interesting time where we could see the gold market into above 2,000. This correction is a counter swing correction that is setting up the market for that target to be completed. We've come down to test the 1870 as the low overnight and reverted from there. So today or last night on the Globex were first indications that this area is a higher level of support. Higher highs are being made, and that's what we want to see. Continue to watch the 1865 level. Either the market is going to go through 1865 and validate the triple bullish trend momentum unfolding, or we're going to get a test, of this level here of the low. If we do, and it does activate the buy one level, these are the areas below today's low or at near the low to use as areas to add to your position. We're almost at the bottom of the barrel, ladies and gentlemen, and I continue to support, I continue to suggest to, first of all, be very careful about adding, risk and so on and so forth, but do it intelligently so that you don't necessarily have to get stopped out of your position, by using just straight stops or over leveraging yourself. I think we have an opportunity here, as I've been saying, for those that are interested in changing your life, you might say, in this environment, using these instruments under the present conditions of the market to benefit and monetize by this crisis. As I always say, crisis is an opportunity, particularly in the commodity markets, in the futures markets, where you get this tremendous volatility, which is really a trader's dream come true. As long as you can manage the risk properly, as long as you don't overtrade based on your profile, you don't get greedy, basically, and you run this as a business proposition for you, this has been a tremendous market last year, and I think it's going to continue to offer tremendous opportunity as we move into 2021. I want to wish you a happy new year again, and wish you all the best, that hopefully this year all your dreams do come true in terms of your trading. And I hope that, again, when you come here, I am a catalyst in helping that dream come true to you every day by you becoming a better trader. Thank you for allowing me to share this information with you. Please take care of yourself, and until next time, my friends, I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Folks, John Najarian here with Steve Collegian, co-founder